What's going on, guys? Today we're going to be talking about Pfizer. This company is down in a major way over the last year, so we are going to take a look at comparisons versus other dividend stocks as well as the S&P 500. We will also go over the company's most recent earnings announcement and what has caused the stock's EPS to fall in a major way, as well as taking a look at their revenue over the last 5 years. We will also take a look at their dividend and discuss what they need to do to keep this dividend safe, and we will leave off by looking at valuation and what analysts are projecting for EPS. So if you enjoyed the video, drop a like down below, and if you want to see more videos like this one, subscribe. As I mentioned in the intro, Pfizer is down over 40% in the last year. If we look at the last 5 years, it's experienced a lot of volatility, but over the last 5 years, it is down almost 27%, and from its highs of almost $60, we can see that the stock has fallen almost 50%. And Pfizer has been known as a very strong dividend company. We can see that its current yield is sitting at 5.38%. If you pay much attention to dividend stocks, you know that they have suffered a lot this year, and one of the most popular dividend ETFs is SCHD, or the Schwab US Dividend Equity ETF. We can see that year to date, this ETF is down a little over 4%. However, if we change this to the 1 year chart, we can see that that number jumps all the way up to 8.5%. And we can see some of the top holdings in this ETF are companies like AbbVie as well as Merck, which are in the same market as Pfizer. And compared to the S&P 500, SCHD has underperformed in a major way. We can see that over the last year, the S&P 500 is up 12% compared to the minus 8.5% of SCHD. But a lot of Pfizer's stock decline has come from underperformance in their earnings. Last year, we saw Pfizer hit an all-time high of trailing 12-month EPS of $5.47. However, since then, their EPS has fallen off a cliff with 3 straight quarters of negative year-over-year growth. We can see at the start of the year, they experienced a year-over-year decline of almost 30% for their EPS, followed up by a 76% decline in EPS, and then the most recent quarter, they actually experienced an EPS loss of minus 42 cents. And when we look at Pfizer's most recent earnings report, we can actually see that this loss of EPS came from the fact that they had a $5.6 billion non-cash inventory write-off that resulted in a loss of 84 cents per share. And what that loss basically comes down to is a lot less usage of their pandemic vaccines. We saw a lot of people obviously going through that phase over the last couple of years of getting vaccines and them being very readily available, as well as being supplemented by the government. However, what we are starting to see is the government is pulling back funding of programs like this, and that is causing Pfizer not only to lose money, but also to have to increase the costs of their vaccines. And this is affecting not only their bottom line EPS numbers, but also their top line revenue numbers. We can see that a year ago, they peaked out around a trailing 12-month revenue of $100 billion. Year over year, we have seen these revenue numbers decline in a major way. In the first quarter, down 30%, in the second quarter, down 50%, and in the third quarter, down 40%. One positive thing is we are starting to see some stability around their revenue numbers. Quarter over quarter, they did experience a little bit of growth, sitting at $13.2 billion in revenue in the most recent quarter. And when we compare that to 2019, before a lot of this additional funding came in, we can see that the numbers back then were sitting around $13 billion as well. Pfizer is a company that is known for having a strong dividend, and we can see that it is currently sitting at 41 cents per share. And what I wanted to do here is take a look at the last time they actually cut their dividend. And we have to go back all the way to 2009 during the great financial crisis, when they cut their dividend from 30 cents down to 15 cents. Despite the massive EPS growth and revenue growth they have seen over the past 3 years, Pfizer has done a very good job of actually minimizing the growth of their dividend, knowing that a lot of this was very short term. So what they have done is we can see that over the last 3 years, they have only grown their dividend by 1 cent each year. In 2021, they were paying out 39 cents. In 2022, they increased that number to 40 cents. And then in 2023, they increased that number to 41 cents. However, even with that slow growth, their payout ratio is currently sitting at 89%, which is relatively high for a dividend stock. Ideally, it would be somewhere around 55 to 65%. And don't let their cheap valuation fool you, because Pfizer is a company that tends to trade between a 10 to 15 forward P ratio to begin with. And we can see that right now they're trading maybe on the lower side of that range, sitting at a forward P ratio of 9.4. And analysts are expecting another loss in the fourth quarter of this year of minus 15 cents. However, when we look at the current year, they're still expecting them to come in with a positive EPS of $1.42. And for 2024, they're expecting that number to grow all the way up to $2.86. So personally, when I'm looking at Pfizer and I see their revenue declining and their EPS declining, I want to see the stock stabilize a little bit more. We have seen their revenue start to stabilize a little bit, and EPS projections are similar to what we saw in 2019. However, I want to see the next couple quarters and see them actually execute on those numbers. However, if we see the stock drop down to maybe $20 to $25, I think that would present a decent buying opportunity, because what we saw back in 2019 is the stock trading around $40. And if we saw the stock price right now fall around $20, that would mean there could be a potential upside of 100%. So keep in mind, that is all my opinion. Do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So with all that said, I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, subscribe. And as always, guys, have a wonderful rest of your day.